Hello viewers, welcome to my channel. I'm Hasham. So now I'm continuing the problems on irrecoverable debt. Last video, two main problems I have explained on irrecoverable debt. This video is the continuation. I'm starting from third problem onwards. So to get a complete command, again I advise my viewers to continuously watch one video with the other. Then only you can get the complete command on the subject. Otherwise, if you join in between or if you leave in between, you may not be able to understand. So before starting the problem, I expect my viewers to have a printout of the problems which I have given in the link under my description. So take a printout and keep it ready. First of all, take a screenshot of the solution of few problems from problem number 3. Then I'll explain each and every point of the problem. Come on, now I'm starting the third problem. See the problem number 3. Bhagya runs a building firm. Bhagya runs a building firm in Kandy. Her business is very successful and has expanded rapidly over the last few years. However, several customers have outstanding bills for over 12 months. So this business woman, Bhagya, she's running the business in Kandy. And the business is successful. But what she is observing, the outstanding bills are accumulating. That means the credit customers are not paying the amount on time. That is her observation. Bhagya has decided to write them off as irrecoverable debt. So there are few customers who have not paid the amount since a long. Now Bhagya has decided to write off that as irrecoverable debt. Now, who are the customers? Rashmi, LKR 8,76,000. Chatura, LKR 457,000. Gyan, LKR 987,000. Prepare the irrecoverable debt account for the year ended 31st March 2017. So, only we are required to make the irrecoverable debt account. So, before preparing the account, you must know the entry for writing off irrecoverable debt. The entry will be irrecoverable debt debit and credit customers credit. Customers account credit. Customers account credit. So irrecoverable account debit, customers account credit. That is the entry for irrecoverable debt. That entry we post it into the ledger account. So we are required to make the ledger account. Irrecoverable debt account. Debit side, credit side. Debit side, date, details, dollar. Credit side, date, details, dollar. First of all, the entry you have to remember, irrecoverable debit and customers credit. So irrecoverable account debit side, 2017, she is writing off on 31st March 2017. So 31st March 2017. The three customers are Rashmi 876,000. Chatura 457,000, Gyan 987,000. This is the entry we have posted, irrecoverable debt. Now, at the end of the year, all the irrecoverable debt should be transferred to income statement. The irrecoverable debt should be transferred to income statement. The entry is income statement debit, irrecoverable debt credit. Already these things I have explained you in the last video also. Income statement debit, irrecoverable account credit. So irrecoverable account credit side, income statement. The total amount, the total of the three customers is 2320. So this 2320,000 will be credited. Income statement 2320. Irrecoverable debt is closed. We have transferred the balance in irrecoverable debt to income statement. That's it. This is the account of irrecoverable debt. Now come to the fourth problem. The Little Teapot maintains a trade receivables ledger control account and an allowance for irrecoverable debt account. On 1st April 2017, the balances were beginning of the year 1st April 2017. The balances in trade receivables ledger control account is $42,640. And allowance for irrecoverable debt account is $2132. The two accounts the business is maintaining, that is trade receivables ledger control account and irrecoverable, allowance for irrecoverable debt account. Both are having the balance at the beginning of the year. Now, the questions are, first, A bit. Calculate the percentage rate used for the allowance for irrecoverable debt. What is the percentage of allowance for irrecoverable debt on trade receivable? We have to calculate the percentage. The formula is allowance for irrecoverable debt divided by trade receivables account into 100. Again, I repeat, if you want to find out the percentage of allowance, the formula is allowance for irrecoverable debt divided by trade receivables account into 100. This will give you the percentage. Now we have to find out. The percentage rate used for allowance for irrecoverable debt is allowance for irrecoverable debt divided by trade receivables account into 100. Now substitute the values. The allowance for irrecoverable debt is 2132 and trade receivables account is 42,640 given in the problem. Beginning of the year, allowance and trade receivables into 100, 5%. That means the allowance for irrecoverable debt is 5% of trade receivable. That's it. Now B bit. On 31st March 2018, end of the year. Actually, beginning of the year was 1st April 2017 and end of the year is 31st March 2018. So what is happening on 31st March 2018, end of the year? On 31st March 2018, the balance on the allowance for irrecoverable debt had increased to $2560. Suggest one reason for the increase. See here. Beginning of the year, we are having only 2,132. Beginning of the year allowance. End of the year allowance has become 2,560. That means end of the year allowance have increased. Now it is asking you, what is the reason why this increase in allowance? Many reasons are there. One of the reason is the trade receivables might have increased. Higher the trade receivables, higher the allowance for irrecoverable debt. That is the reason. More trade receivables, more allowance for irrecoverable debt. So we give the suggestion that end of the year, the trade receivables might have increased, due to which the allowance for irrecoverable debt has increased. That is the reason. The number of irrecoverable debt has increased, so it would be prudent to increase the provision so that the profits are not overstated. If we do not increase the allowance, then what will happen? The profit will be overstated. So when we don't want the profit to be overstated, we have to provide appropriate allowance for irrecoverable debt. Since they maintain a percentage rate, it may be the amount of trade receivables has increased because they are following percentage. Beginning of the year 5%, end of the year 5%. So then when percentages are same, then how come the allowance has increased? Because trade receivables have increased. The business has sold more goods on credit. The credit customers have increased, due to which the allowance might have increased. Second question, B bit completed. Now C bit, prepare the journal entry to record the change in the allowance for irrecoverable debt. Now see here, journal entry is already in the first theory video and also in the next short questions also I have explained you. When there is increase in allowance for irrecoverable debt, the entry is income statement debit, allowance for irrecoverable debt credit. So many times I told you in the last video also. Here in our problem, the allowance of irrecoverable debt has increased. Beginning of the year only 2,132. End of the year it is 2,560. Increase in allowance. So entry will be income statement debit, allowance for irrecoverable debt credit. Journal entry to record the change in the allowance for recoverable debt. Income statement debit 428. Allowance for irrecoverable credit 428. How we got this 428? Difference between the opening and closing. The closing allowance is 2,560 and the opening allowance is 2,132. That's it. Now, fifth problem. Emma Ball has trade receivable totaling $38,000. She wishes to make an allowance for irrecoverable debt at 4%. So, allowance for irrecoverable debt is given 4%. This 4% will be calculated on trade receivable. Trade receivable are 38,000. A bit. Calculate the allowance for irrecoverable debt. So, allowance for irrecoverable debt. Trade receivables are 38,000. Percentage is 4%. 4 by 100. It comes to $1,520. A bit completed. It is simply asking you to calculate the allowance for irrecoverable debt. B. Prepare a statement of financial position to show the allowance is how the allowance is treated. This allowance, how it will be shown in the statement of financial position. In the statement of financial position, we will have current assets. Under current assets, we will have trade receivable. From trade receivable, we should deduct the allowance for irrecoverable debt. So here statement of financial position extract, only a part is there. Then current assets. Under current assets, trade receivable 38,000. From that deduct allowance for irrecoverable debt 1520. 36,480 is the net trade receivable. That's it. This is the fifth problem. Now I am coming to the sixth problem. Bharat, a trader, is experiencing late payment from customers. Bharat is the trader, businessman. He is experiencing, observing that his customers are late in payment, delaying in paying the amount. Delayed will be money denied. That means if the customers take more and more longer period of time, there are chances of more irrecoverable debt. Here Bharat is experiencing that his customers are not paying on time. Explain two ways in which he can encourage his customers to pay their accounts on time. It's a theoretical question. Two ways we have to suggest to Bharat in order to improve his cash flows, in order to reduce his irrecoverable debt. Nobody wants irrecoverable debt because irrecoverable debt is a loss to the business. We should try to minimize irrecoverable debt by taking some steps. So it is asking you how explain two ways in which he can encourage his customers to pay the amount on time. The first suggestion we can give to the businessman is give some cash discount to the customers. Offer some cash discount to the customers so that customers will come and pay before the due date. Before the specified, they will come and pay the amount to get the advantage of cash discount. The first suggestion we'll give to Bharat is offer some cash discount to the customers, then customers will pay the amount before the specified time. First suggestion. Second suggestion, improve the credit collection methods. That means timely statements should be issued to the customers. When the amount is becoming due, before the amount becoming due, some reminders, some statements should be issued to the customers asking them that the specified date is approaching fast, please pay the amount on time. Like this. Some procedure, some arrangement has to be made to make effective control over collections. So here I have specified Bharat could offer his customers a cash discount if they pay their accounts within a specified period. So first suggestion, we suggest to give some cash discount. Then which would improve his cash flow. Bharat could ensure that invoices are issued promptly. Bharat have to see that the invoices are issued, the statements are issued promptly to the customers. There should not be any delay in the issuing of statements and monthly statements to his customer which would remind them to pay the amount due time to time. So when Bharat issues timely statements, invoices, reminders to the customers to pay the amount, then definitely it will accelerate the flow of cash. That means the possibility of irrecoverable debt will reduce. So these are the two suggestions we can give to Bharat. C point. It is B point. Bharat maintains an allowance for irrecoverable debt at 5% of trade receivable. His trade receivable amounted to $35,000 on 1st April 2013 and $40,000 on 31st March 2014. Prepare the allowance for irrecoverable debt account for the year ended 31st March 2014. Balance the account on the debt and bring down the balance on 1st April 2014. Our year begins from 1st April 2013 and year ends on 31st March 2014. The beginning of the year trade receivables are $35,000. End of the year trade receivables are $40,000 and the allowance percentage is 5%. So we calculate 5% of 35,000 opening allowance. We calculate 5% of 40,000 closing allowance. So we have opening allowance, we have closing allowance. Simply we have to make an account. Provision for irrecoverable debt account, or we can write allowance for irrecoverable debt account. Both means same, right? First of all, beginning 1st April 2013, credit side, balance brought down. Balance brought down, credit side. 1st April 2013, beginning of the year. The beginning of the year, the trade receivables are 35,000. So I am taking 35,000 into 5 by 100. 35,000 into 5 by 100. It comes to 1750. The 1,750 is the opening allowance. Now ending, closing allowance is 5% of 40,000. So 5% of 40,000 comes to 2,000. If you calculate 40,000 into 5 by 100, you will get 2,000. The beginning of the year 1750, end of the year 2,000. That means end of the year it has increased by 250. $250 increased. So entry will be income statement debit, allowance credit. Income statement debit, allowance credit 250. So allowance credit side, income statement 2000 minus 1750 is 250. 250 is the increase that will be taken on the credit side. Last date 31st March 2014. Now balance. Take the total on the credit side 2000, 2000, balance carried down 2000. Balancing figure. Current year 2014 March 31st. Now brought down balance. Brought down balance 2000 April 1st 2014. That's all. So we have completed the allowance for irrecoverable debt. Last D question. Explain the effect on the net profit for the year ended 31st March 2014 if Bharat's trade receivable had decreased and the allowance for irrecoverable debts are maintained at 5%. What is the effect on the net profit if the trade receivables have decreased? When trade receivables decreases, the allowance for irrecoverable debt also decreases. There is direct relationship between trade receivables and percentage allowance for irrecoverable debt. Higher the trade receivable, more is the allowance. Lesser is the trade receivable, lesser is the allowance. So here it is saying when trade receivables have decreased. So naturally, when trade receivables decreases, allowance will also decrease. When allowance decreases, the profit will increase. The profit will increase. So it is asking you what is the effect on profit. So my answer is, if trade receivable decreases, allowance for irrecoverable debt also decreases. When allowance for irrecoverable decreases, profit will increase. That is the answer. So here, if the provision for irrecoverable debt decreases at the year end, it can increase the profit as Bharat's customers' balance have decreased. Then his provision would also decrease, resulting in additional income which would increase his profit. Whatever I said, the same thing. This is the end of problem number 6. Now 7th problem you see. Vijay maintains an allowance for irrecoverable debt at 2.5% of trade receivable. His trade receivable amounted to $24,000 on 1st June 2018 and $32 on 31st May 2019. The beginning of the year 1st June 2018 and end of the year 31st May 2019. The beginning of the year trade receivable 24,000 and end of the year 32,000. The allowance is at the rate of 2.5%. So first of all, we calculate how much is the allowance at the beginning of the year and how much is the allowance at the end of the year. Here you can see. Allowance for irrecoverable debt on 1st June 2018, beginning of the year. The beginning of the year 24,000 trade receivable into percentage is 2.5%. So 2.5 by 100, you will get 600. That means allowance at the beginning of the year 600. Similarly, end of the year, the trade receivables are 32,000. End of the year. So allowance for irrecoverable debt on 31st May 2019, 32,000, 2.5 by 100, 800. So we have calculated the amount of allowance. Beginning of the year 600, end of the year 800. Prepare an allowance for irrecoverable debt account for the year ended 31st May 2019. Bring down the balance on 1st June 2019. That's it. So simple. So many problems we have prepared the irrecoverable allowance for irrecoverable debt account. The provision for irrecoverable debt account, debit side date details dollar, credit side date details row. First of all, opening balance should be taken on the credit side. The credit side balance brought down 600. At what date? To 2018 June 1st. 2018 June 1st. This is the beginning of the year. Now end of the year 31st May 2019. We have to see whether there is increase or decrease. There is increase. Beginning of the year 600, end of the year 800. That means 200 allowance have increased. The entries: income statement debit, allowance for irrecoverable debt credit. So credit side, income statement 800 minus 600, 200. Now take the total credit side 800, same total 800. Now balancing figure, balance carried down 800. Last date 2019 May 31st. May 31st. Then brought down. Next year we will start at June 1st to 2019. Balance brought down 800. That's it. So we have completed 7 main problems on irrecoverable debt. Inshallah, the next problem will start in the next video.